You've slashed your credit card debt, you've paid your student loans, and you're investing for your retirement. So now you're moving on to your mortgage. What's the best strategy for making extra mortgage payments, you might be asking? Well, deciding on monthly or yearly extra payments isn't a one-size-fits-all scenario. Instead, it depends on several different factors. Let's explore monthly and yearly extra mortgage payments to see which option is right for you. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree and live financially free. Thanks for being here today. First of all, is making extra mortgage payments even a good idea? Well, in short, yes, it can be. Really good idea. Extra mortgage payments can certainly help you out on your journey. That's how we paid off our mortgage in under 5 years. However, there are definitely other ways to use extra money that you want to also consider. Let's go over those ones first before diving into extra mortgage payments. Pay off higher interest debt. Do you have credit card debt in your life? The interest rate is likely much higher than your mortgage. As a result, you want to pay that credit card off first. Before you send extra to your mortgage, check your other debt. Any debt that is at a higher interest rate than your mortgage should be tackled first. If your goal is to save money, getting rid of your high interest debt first is the absolute first way to go. Build an emergency fund. After you've tackled your high interest debt, check in on your emergency fund. Some people suggest a $1,000 emergency fund is a good place to start. That amount works when someone is just getting started, but the reality is you need a lot more than that saved. The idea behind an emergency fund is to protect yourself in case of an emergency. That way you can deal with whatever situation you're dealing with without sabotaging your finances as well. A good target for many people to have is 3 to 6 months of expenses set aside. Other people take a more conservative approach and save 6 to 12 months. Figure out an amount that would help you comfortably weather any storm, be it job loss, medical emergencies, or something else. Invest until coast fire. You've probably heard people say timing the market doesn't matter, but time in the market does. What that means is the best way to invest is to simply let your investments grow as long as possible. If paying down your mortgage means you can't invest for your future retirement, you might want to reconsider doing that. Some people believe that it's better to hit all of your investing milestones before paying off your mortgage early. For us, we think investing until coast fire does the trick. Coast fire is the point in your investment journey where you have the option to decrease or even stop contributions and still hit your retirement goals. If you want to learn more about coast fire, check out our videos in our description. Ultimately, personal finance is personal, so you decide the best way to use your extra dollars. Then pay off your mortgage early. Once you've tackled those other money milestones, you're ready to pay off your mortgage early. Making those extra mortgage payments lowers your overall expenses and gives you more freedom to use your money and time how you please. As you continue down your early mortgage payoff journey, you might consider options to refinance or recast your mortgage for more savings. Now let's explore what happens when you make those extra payments. Let's start with yearly extra payments. Some people prefer to make an extra mortgage payment each year. The amount varies, usually based on where the extra money comes from. Are you paid biweekly? Then you earn 26 paychecks per year. However, most people budget based on 24 paychecks, or 2 per month. That means you have 2 paychecks that are unaccounted for in your budget. You could save one or both of those paychecks and make an extra yearly payment. Other options might include putting a bonus or windfall toward your mortgage. No matter how you come up with the money, making an extra yearly payment can definitely help. Paying an extra $1,000, $2,000, $5,000 or more toward your mortgage principal reduces the principal. That means that you're paying less in interest over the course of your mortgage. It also means that you're saving time. You could turn a 30-year mortgage into something much shorter with those extra yearly payments. Let's see what this would do for someone with a 30-year mortgage. Here are the details of that person's situation. The mortgage type, again, is a 30-year fixed rate. The interest rate is 6%. The original loan amount is $400,000. the extra mortgage payment, which would be annually $6,000, and that's made in January. The remaining years on the mortgage are 30 years, assuming this person just got the mortgage and wants to pay it off over time. In this situation, this individual could shave 10 years off of their mortgage and reduce their total interest paid by $183,000. Now let's jump over to what happens when you make an extra mortgage payment each month. The benefits of making extra mortgage payments each month are similar to making extra yearly payments. You are saving on interest and whittling away the principal. That means that you can considerably shorten the life of your mortgage and the amount of interest that you pay. An added bonus of making extra payments each month is that you can exercise this muscle regularly. You might start by setting aside the money that you would normally spend on impulse purchases. As you see that money start to work in your favor, your desire to save even more will grow. Of course, you can only save so much. So you might start a side hustle or add overtime income to make a bigger monthly payment. Here's an example of an extra mortgage payment per month. Let's go over that similar situation with the same details as last time. A 30-year fixed rate mortgage, 6% on the interest rate, $400,000 original loan amount, and the extra payment is now $500 per month. Again, the same as the $6,000 starting in January. Remaining years on that mortgage is 30 years. Again, same thing. We're assuming this person just got the mortgage and they want to pay it off over time. In this situation, this individual could again shave 10 years off of their mortgage and reduce their total interest paid by $182,636. This is slightly less than if the individual were to make a one lump sum payment at the beginning of the year in January. But not by much, really. To see how this works for your situation, check out our free mortgage payoff calculator. You can see the impact of extra monthly payments and what they can do for your budget. Use the links below or click the link in our video description. So in the end, what's better, monthly or annual extra mortgage principal payments? Well, the reality is there are benefits to both monthly and yearly extra payments. Both methods reduce the amount of interest you pay over the life of the loan nearly identically. Additionally, either option reduces your mortgage balance and increases your home equity. For many people, it comes down to preference. Sometimes it's easier to set aside a windfall like an end-of-year bonus. In that case, you'd likely prefer a yearly payment. However, other times, people can find ways to make extra payments each month by reducing their spending or side hustling. It's also worth noting that your mortgage strategy can change over time. You might start off with yearly payments and then switch to monthly. At certain points in time, you might even choose to pause making extra payments entirely. If your finances or your family situation changes, you'll want to adjust these extra payments accordingly. Just know that however you decide to make extra mortgage payments, you're doing something really powerful for your finances. Check out our mortgage payoff calculator to see how extra payments can get you a paid off house faster. Use the links below or click the link in our video description. To inspire you on your mortgage-free journey, check out this next video. Carpe diem.